Hello and welcome to Inside ETFs. I'm Ramzan Karamali. Today we're looking at dividend ETFs and my guest is Sean O'Hara, President of Pacer ETFs. Since Jerome Powell's congressional testimony back in July, inflows into dividend ETFs began to increase as investors looked for income beyond the money markets. And in fact, the day after the Fed cut rates, Spider's S&P Dividend ETF, SDY, attracted $50 million of inflows in just 24 hours, its largest one-day inflow since the end of last year. And it's no surprise that it's been in demand. Over the past 3 months, it's easily outperformed the S&P 500 index. So will these types of funds continue to prove popular? And how do investors choose which ones to buy? Well, to help answer that and more, I'm joined by Sean O'Hara from Pacer ETFs. Sean, thanks so much for joining us. Well, let's start with the obvious question. What's the investment case of these types of funds versus the main S&P 500 index at the moment?
Well, as you said, I think the biggest change recently was the Fed's posture change, one from raising rates to now cutting. And so, for those who have been sort of hiding in T-bills and earning 5%, I think the writing is on the wall. That's going to slowly but surely sort of go into the rearview mirror as we're driving down the road. And so those investors need to replace that income. And one of the ways that they could certainly replace that income is to buy equity strategies that generate income. Some popular dividend strategies, for example, there are covered call strategies you could use. We have an ETF series that we use, the dividend multipliers. But I think that's the real reason why you're seeing the big shift is that now, I guess adding to that, generally if the Fed's cutting, that's generally better for stocks as well. So you have sort of two things going on. One is investor demand. There's some $9 trillion sitting on the sidelines, and it knows its days are numbered in terms of getting attractive yields, and it's now going to try to look for a better place to be.
But why don't long-term investors choose, say, high-yielding corporate bonds or long-dated government bonds? I mean, the yield on the 10-year is just shy of 3.75%.
Yeah, that's also a way to go about it. That's on the fixed income side for sure. The thing about the 10-year to me is that where it is right now is, in order for there to be any real appreciation there, rates have to go down pretty substantially. So I don't think there's that duration play there. In other words, as rates come down, you get a little extra total return for your bonds. I think that's available, for example, on corporates and high yield. And they come with a sort of a different set of risks. I mean, spreads are fairly narrow right now on high yield. So traditionally, investors who wanted income would use bonds as one way to get there. And then getting a dividend or some kind of an income for your equity portfolio would be the other way.
Now, I mentioned SDY at the start. In its asset allocations, they've chosen oil and REITs among its top holdings. What should investors look out for when it comes to asset allocations?
Well, I think if you search for dividends first, right, then you wind up buying stocks that don't have great growth profiles. In other words, they pay a high dividend because they can't give you appreciation, and real estate would be an example of that. So I'd be worried, for example, about that in terms of long-term appreciation. Not only do I need income now, but I need income down the road as well. And the best way to get more income down the road is to have your principal value grow. And so a strategy like SDY, although it's attractive today, may not necessarily provide the long-term growth of capital that would allow that income investor to get higher and higher income down the road and stay ahead of inflation.
Sean, your own ETF, the Pacer Global Cash Cows Dividend ETF, or GCOW, has tobacco and pharma names among its top holdings. Why is that?
Well, that strategy works on two things. The first thing we do is we screen for the 300 companies out of that broad index that we use, which is a FTSE index, that have the highest free cash flow yield. And free cash flow yield is the free cash flow a company generates divided by its enterprise value. It's just a simple valuation metric. So if I have a high free cash flow yield, it means that after I pay all my bills, I've got an excess of free cash flow coming out. And so then what we do is we pick the 100 stocks out of that 300 stock group that have the highest dividend. And if you're going to pay dividends, you have to have free cash flow to do that. But by not using dividends first as my focus, I wind up owning a variety of different types of stocks in different sectors that have potentially better growth. And so I'm getting what I want. I'm getting an attractive yield today, but I'm also in a position where I can grow my capital better over time.
Sean O'Hara from Pacer ETFs, many thanks for your thoughts. And that was your look at dividend ETFs. I'm Ramzan Karamali, and this is Reuters.